think the key question is, with record highs, are we due for a correction? My view is that the macro picture is so strong that it's always possible you get a correction, but the probability is probably lower than most people think. Currently, we're sitting at neutral between stocks and bonds. We bought a lot of stocks around the bottom for our clients and we rode the recovery. But right now, the macro picture is just outstanding. We just had record services ISM numbers, 63.7. You had strong job numbers on Friday. Pedal to the metal, fiscal and monetary stimulus, 25 trillion globally. And you have $1.5 trillion in excess household savings, which has to translate into pent-up demand. So the macro picture is so strong that I think its probability of a correction is probably lower than most people think. It is a valuation question, however. The way I like to look at it is looking at free cash flows. And thanks to big tech, free cash flow yield on the markets is fairly high, and it's high relative to the 10-year yield. So by that measure, valuation is kind of in the eye of the beholder. Equities are somewhere between kind of normally valued and bubble territory, somewhere in between there. So we end up neutral between stocks and bonds. Okay. We're along the recovery trade underneath, though.
All right, well, let me ask you about that, because I do want to know how we're supposed to be positioned. Somebody sent me a really interesting stat, and it plays right into our conversation. The bottom 25 stocks from 2020 are up 32% so far this year. The top 25 from last year are down 3%, right? It speaks to the rotation that we've seen. The real question is, does it have staying power?
I think the rotation has staying power. We, for the first time in 10 years, a few months ago, started overweighting value stocks relative to growth stocks. We're also long small cap stocks, emerging markets, and credit. I think the recovery trade has legs. And while you've seen a good run, and you've also seen a correction in some highly valued, no revenue software type companies, you still have room. Look, the value index, look at the Russell 3. The value index is still 49% below the growth index over the last 3 years. So there's a valuation case. And as I was saying earlier, there's a macro case also for the recovery trade. So you have both value in terms of valuation and some momentum macroeconomic picture. This ticks a lot of boxes for the recovery trade. So we'll remain positioned that way.
Can that all work in an environment where yields are rising as quickly as they have been in recent weeks? Not today, but that's certainly been a theme.
Yeah, I think, Sarah, that is the biggest question for any asset allocator this year is, will rising rates hurt risk assets? I think it's unlikely, and we have to realize that the Fed is only comfortable typically raising rates in a strong economic growth environment. And in fact, the interesting thing, if you go back 30 years, there's 72 periods on a rolling 12-month basis during which the 10-year yield went up by 50 basis points or more. 72 of those periods. And the average return for stocks during those rising rates environments is 17% historically. And in fact, the hit ratio, stocks have made money in every of these 72 rolling 12-month periods when rates were rising. It's not that rising rates cause stocks to go up. It's just that they coincide with economic growth and recovery. You do have environments where you have taper type risk and also risk like the 70s where you can really get stagflation, but I don't think that's the central scenario in this current environment. So my view is rising rates aren't necessarily bad for stocks in this environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.